measured. On a $400,000 home, the comfortable mortgage payment can cost you roughly $245,000 in additional interest. You put down $80,000, you borrow $320,000. Property taxes, insurance, maintenance, and the shelter you receive are identical. So they cancel out of this comparison. Only the mortgage changes. At 6.5%, the 30-year principal and interest payment is about $2,023 a month. At 5.9%, the 15-year payment is about $2,683. The 30-year frees roughly $660 every month. That feels safer. Maybe it is safer. But if both loans survive for their full terms, the 30-year charges about $408,000 in interest. The 15-year charges about $163,000. Same house, same down payment, same original debt. Approximately $245,000 more interest for the lower required payment. The 15-year payment is not higher because its rate is worse. Its rate is lower. The payment shock comes from returning $320,000 of principal in half the time. Across the entire schedule, the 30-year borrower sends the lender approximately $728,000. That is about 2.3 times the amount borrowed. The 15-year borrower sends approximately $483,000, or about 1.5 times the original loan. Brief pause. That appears to end the argument very quickly. It does not, because the $245,000 gap is a full-term result, and a mortgage is not always held for its full term. You may sell, refinance, move, downsize, or pay the balance early. Adam's data for homes sold in the fourth quarter of 2025 found that the sellers had owned those homes for an average of 8.55 years. That was unusually long by the standards of the previous quarter century, yet still nowhere near 30 years. So the six-figure headline is valid under the stated full-term assumptions, but it is not a guaranteed realized loss for every borrower. The shorter holding period does not make the term irrelevant though, because the 30-year schedule moves slowly when you need it to move fastest. On your first 30-year payment, roughly 86% goes to interest. Only about $289 reduces your debt. After 5 years, interest still consumes around 80% of that month's payment. After 10 years, the interest share remains close to 73%. At roughly 8.5 years, the 30-year balance is still near $280,000. The 15-year balance is closer to $172,000. That is approximately $109,000 more equity on the shorter schedule. But be careful with that number. You did not earn the entire $109,000. You made about $68,000 of additional payments, and you avoided roughly $41,000 of interest. Contribution and return are not the same thing. Housing folklore loves combining them because the larger number sounds better. The practical result is still meaningful. If you sell around that average holding period, the 15-year borrower reaches closing with substantially less debt. The full $245,000 interest gap has not appeared, but the 30-year borrower has already paid around $40,000 more interest and still owes much more principal. That gives the 30-year mortgage a burden to overcome. Fortunately, it also gives you an asset the 15-year borrower does not initially have, $660 of monthly cash flow. By the way, if this kind of housing math is useful, subscribing to Lazy Investor helps a lot, and I appreciate everyone who does. Now, give that $660 a real job. It leaves your checking account every month and enters a diversified investment portfolio. No skipped months. No spending it on a nicer vehicle because the mortgage felt affordable. No pausing after a market decline. The transfer occurs 360 times. At a 7% nominal return, that stream grows to approximately $806,000 after 30 years. At 10%, it reaches roughly $1,490,000. These are before tax scenario values, not forecasts. The higher number is what makes the 30-year argument so appealing. Start earlier, stay invested longer, and allow compounding to work on money that would otherwise be trapped in the mortgage. S&P, Dow Jones Indices estimates that the S&P 500 has produced a total return around 10% annualized over its live history since 1957. That makes 10% defensible as a historical illustration. It does not make 10% available on demand during your particular 30-year window, and it certainly does not arrive as a smooth monthly credit. Still, the 30-year side now appears to have solved the problem. You paid more mortgage interest, but you built an investment account potentially worth far more than the interest gap. Except the comparison normally used to produce that conclusion quietly freezes the 15-year borrower at year 15. That borrower does not pay off the house and spend the next 15 years admiring the amortization schedule. Once the mortgage disappears, the entire former payment becomes available. Beginning in year 16, the 15-year borrower can invest $2,683 every month for the remaining 15 years. The comparison is now symmetrical. The 30-year borrower invests $660 for 30 years while continuing to make mortgage payments. The 15-year borrower directs the extra money toward debt first, then invests the full former payment for 15 years. Both borrowers own the same home free and clear at year 30. Whatever the house appreciates to is identical on both sides, so the home value cancels. The question is which contribution schedule creates the larger portfolio. At 7%, the 30-year strategy finishes with about $806,000. The 15-year strategy finishes with approximately $850,000. The shorter mortgage is ahead by roughly $45,000 with restrained disbelief. So earning more than the 6.5% mortgage rate was not enough. That popular shortcut fails because you are not comparing investing against doing nothing. You are comparing early, smaller contributions on the 30-year side with later, much larger contributions on the 15-year side. You are also comparing a 6.5% debt with a 5.9% debt. Raise the investment return to 10% and the result reverses. The 30-year investor finishes near $1,490,000. The 15-year investor reaches around $1,112,000. Now, the 30-year strategy leads by approximately $381,000. Starting earlier becomes more valuable as the investment return rises because each of those first contributions receives decades to compound. The higher return does not add equal amounts to both strategies. It disproportionately rewards the money invested during the first 15 years. You do not need another parade of return assumptions. You need the crossover. Under these stated mortgage rates, payments, monthly contribution timing, and a 30-year endpoint, the break-even investment return is roughly 7.5% nominal before investment taxes and fees. Around 7.4%, the 15-year strategy remains slightly ahead. Around 7.5%, the 30-year strategy moves slightly ahead. That is the mathematical price of the monthly comfort. The 30-year borrower must invest every dollar of the difference and earn roughly 7.5% over the comparison period to overcome the cheaper rate and later investing power of the 15-year borrower. Below that line, the 15-year wins this full-term model. Above it, the 30-year plus investing wins. At the line, the portfolios are approximately equal, and you are left comparing liquidity, volatility, and the certainty of the payoff date. A savings account does not clear that hurdle. In early August 2026, leading no-fee high-yield savings accounts were offering rates as high as roughly 4.2%. Useful for emergency reserves, yes. Enough to make the 30-year investment strategy win this calculation? No. Savings yields are also variable and can decline. To reach the modeled crossover, you generally need an asset with market risk or another return source capable of exceeding cash. That introduces volatility. Your $660 may be buying shares during a bear market. Your portfolio may trail the projection for years. A 30-year average cannot protect you from a poor sequence when retirement or a job change arrives earlier than planned. The mortgage balance behaves differently. A principal payment produces a known reduction in debt. It does not create accessible cash. But the interest avoided is not waiting for the stock market to cooperate. Taxes complicate the crossover in both directions. Mortgage interest can create a federal tax benefit only if you itemize. For tax year 2026, the standard deduction is $32,200 for married couples filing jointly, $16,100 for single filers, and $24,150 for heads of household. Your itemized deductions need to exceed the relevant standard deduction before itemizing produces an incremental benefit. The $320,000 acquisition loan is below the current federal acquisition debt ceiling for a qualifying newer mortgage. But that does not convert every dollar of interest into a tax saving. A deduction reduces taxable income. It does not reimburse the interest, and it does nothing for you if the standard deduction remains better. Investment taxes and fees can pull in the opposite direction by reducing the portfolio's return. A tax-advantaged retirement account, a taxable brokerage account, state taxes, turnover, and your tax bracket can all produce different after-tax crossovers. So 7.5% is the clean pre-tax planning hurdle, not a personalized promise carried to 2 decimal places. Fake precision is especially annoying when the variables include Congress, markets, and your own behavior. More seriously, behavior is not a side note in this comparison. It is embedded in the return assumption. The 30-year strategy did not reach $806,000 at 7% because the payment was lower. It reached that amount because you invested the difference 360 consecutive times. Miss the transfers and the advantage shrinks. Spend the difference, and the investment case disappears while the higher interest remains. The Federal Reserve survey covering 2025 found that only 55% of adults had enough emergency savings to cover 3 months of expenses. That does not prove what you will do, but it shows why freely available cash cannot automatically be treated as long-term invested capital. Household demands arrive before elegant spreadsheets finish compounding. Repairs arrive, travel arrives, family support arrives. A market decline makes stopping contributions feel cautious at exactly the time your modeled return assumes continued buying. If you choose the 30-year because you plan to invest the difference, the automatic transfer is part of the mortgage strategy. It should occur near the payment date before the money becomes available for lifestyle expansion. Describes regular automatic contributions as a way to maintain consistent investing through changing markets. In this comparison, automation is not motivational decoration. It is one of the assumptions holding up the result. The 30-year does have another legitimate use for the difference. You can send additional money to principal while retaining the lower contractual minimum. Standard Fannie Mae eligible conventional loans cannot contain prepayment penalty provisions, and the Consumer Financial Protection Bureau notes that small additional principal payments normally do not trigger such penalties. Your actual note controls, so you still check the documents rather than relying on a slogan. That optionality matters. During a strong month, you can prepay. During a weak month, you owe only $2,023 in principal and interest, rather than $2,683. But paying the 15-year amount on the 30-year loan does not reproduce the stated 15-year mortgage. The rate remains 6.5% rather than 5.9%. To amortize that higher rate loan in exactly 15 years, the required payment would be approximately $2,788, about $105 more than the actual 15-year payment. The 30-year therefore offers reversible acceleration, not a free 15-year mortgage hiding inside a lower payment. Flexibility is real. The lower rate is not. And this is where the governing problem changes. You are no longer choosing the loan with the prettiest terminal balance. You are choosing the required payment your household can survive. A principal and interest obligation of $2,683 is roughly 1/3 higher than $2,023. Taxes, insurance, and maintenance sit on top of both. If the larger payment forces you to drain reserves after a repair, carry credit card debt, or reduce retirement contributions needed for an employer match, the cheaper mortgage can damage the rest of your balance sheet. For a late career buyer, the risk becomes sharper. If you take a 15-year loan at age 55, the scheduled payoff arrives around age 70. A 30-year loan reaches age 85 unless you prepay, sell, or refinance. The shorter term can protect retirement cash flow, but only if its required payment does not weaken the years leading into retirement. A job transition at 58 is not the same problem as one at 38. You have fewer peak earning years available to repair depleted liquidity, and taking portfolio withdrawals during a bad market can be more expensive than the interest you are trying to avoid. Carefully. The 15-year mortgage earns the right to compete only after passing a capacity test. Take the complete monthly housing costs, including principal, interest, taxes, insurance, association fees if any, and a realistic repair reserve. Then ask whether that cost can survive a bad year without consumer debt, abandoned retirement contributions, or an emergency fund falling below the amount your household actually needs. If the 15-year fails that test, its interest savings do not rescue it. The lower required obligation is safer, or the $400,000 purchase price is too high. Those are the available conclusions. There is no prize for selecting the mathematically cheapest loan and becoming financially brittle. The 30-year has its own test. The $660 must be automatically invested, deliberately prepaid, or consciously retained for a defined liquidity need. More breathing room is not a destination for money. It is an invitation for every recurring expense to expand until the room disappears. If you have been getting value from these numbers, subscribing helps Lazy Investor keep doing the tedious housing arithmetic, so thank you to the people who do. When both payments are comfortably affordable, your behavior becomes the binding constraint. If extra cash tends to remain unassigned, the 15-year can function as forced savings. Every required payment builds principal faster, and you cannot casually redirect that money toward a more expensive lifestyle. That forced savings feature is valuable only while the payment remains safe. A financial tool stops being disciplined when one bad year forces you to borrow at 20% to protect a mortgage charging less than 6%. If both terms pass the capacity test, and you will automate the difference into a diversified portfolio, accept volatility, and maintain the plan, the 30-year can create more terminal wealth when your realized return exceeds roughly 7.5% before taxes and fees. If your expected return falls below that hurdle, or certainty matters more than modeled upside, the 15-year becomes stronger. You receive the lower mortgage rate, a fixed payoff date, and a known interest reduction without depending on market performance. If you plan to move in 6, 8, or 10 years, ignore the dramatic 30-year lifetime total and compare the actual loan balances, interest paid, transaction costs, and investment balance at your expected sale date. The full-term winner is not automatically the winner at your horizon. If you value liquidity because your income is uncertain, retirement is close, or much of your wealth is already trapped in the house, the 30-year minimum may be worth paying for even when it does not maximize the modeled ending value. Liquidity has a job. It keeps a temporary problem from becoming an expensive forced sale. If your main objective is entering retirement without a mortgage, the 15-year can remain rational even when the 30-year carries higher expected upside. A paid-off primary residence does not produce portfolio income, but it lowers the income your retirement portfolio must produce each month. The house is either a wealth decision or a lifestyle decision, pretending it's both, is how the math breaks. Slows down. The 30 years comfort costs 6 figures when the extra interest accumulates and the payment difference creates no offsetting asset. The 15 years savings are worth buying only when the larger required payment remains safe through a bad year. That $660 is not saved by choosing the 30-year. It receives a job or it becomes the comfort tax.